Hey, this is Warren Redlick. I'm trying something a little bit different with my Tesla investing. I've got a new Tesla options strategy. I want to stress before we start, I don't recommend this for anyone. I'm just telling you what I'm doing. This is a very small part of my portfolio. I don't recommend anybody do this with more than 5% of your portfolio, and my investment in this strategy is less than 5% of my portfolio. If it goes south, you lose 5%. For me, that's an acceptable loss. Like, and I don't use margin. I don't play any games. I mean, this is a game, but other than what I'm about to describe, I don't play any games. I don't think going on margin is a good idea. I don't think doing this at a large scale is a good idea. This isn't like selling covered calls. There's a lot of people who have short-term strategies. This is a long-term option strategy I'm going to get into, basically buying options that have a strike date 2 years out that are way out of the money. You're unlike that somebody looking at the outside would say you're probably going to lose on that. So there's a high risk that you're not going to recover anything at all and you're going to burn some cash. But the advantage is if you believe, as I do, that Tesla is likely to grow large in the medium to long term, the potential for gain is very high. So, like me personally, I think Tesla might hit, let's say, $2,000 a share by January 2027, which is the option I'm going to be showing you later. And the gain from that is much, much higher than just buying stock. So let me dive into this a little bit and I'll tell you a little bit about where I'm coming from. This is an option that I hold currently. I started playing this game a while back, August 2023. I actually started before this. I have a couple other options that have done, but this is the one I still have right now. And this is an example of how it can work out positively. Before I get into this, the first option I bought was worthless. I let it expire worthless. So that was probably $5,000 or $10,000 and I lost it. So you have to be prepared when you play this game. Sometimes you lose. I've done this 4 times now. The first time I did it, it failed. The second 2 have done pretty well, but I think on average you would expect maybe 50-50 at best and possibly worse depending on how you play this game. This is an option that I bought August 15th, 2023. I've got 5 options, which means the option to buy 500 shares at the strike price. The strike price you can see up here is $550 on the strike date, December 19th, 2025. So looking to the end of 2025, this option allows me to buy 500 shares, or these 5 options allow me to buy 500 shares of Tesla at $550 a share. This is worthless if Tesla is trading at less than $550 a share in December 19th of 2025. If it's trading at 551, then it's worth something, but not very much, and you lose money. But if it's trading at 1,000, then you make a lot of money. That's the idea. That's the big idea. And you can see right here, I'm up 5x right now. Because the stock has risen, it's somewhere around 480. Last time I looked, as I'm speaking, it's around 480. This is up 5x. What I paid for the options was about $10,000, and it's risen $41,000. So I'm up more than 5x. You can see 404%. 400% would be a 5x. So that's a really positive result. This is assuming it holds up in April. I'm going to buy a Model Y with probably going to buy a Model Y with this money. And I should mention, this is in a brokerage account, which means when I cash this in, assuming it's still positive when the time comes, whenever I decide to cash it in, I pay capital gains tax on it. Now I've held this for significantly more than a year, so I pay, and talk to your tax lawyer, your tax accountant on this. I'm telling you what I think I'm correct on here. Because I've held this more than a year, I pay long-term capital gains tax on it, not short-term capital gains tax. I don't remember whether the break point is 6 months or a year. The point is make sure you know what you're doing when that comes up. Because this is in a brokerage account, there will be taxes. My other options plays have all been in a Roth IRA. In a Roth IRA, there's no taxes when you take the money out. There's no capital gains. So my advice is if you have a Roth IRA, that's the place to do this strategy, because if it works out, you get a big win and you don't pay any taxes on the big win. If you have a big win in a brokerage account and you pay, let's say 15%, it doesn't suck to pay 15%, but it's a lot better to pay 0. And if it's in a regular IRA, when you take the money out, you pay regular income tax on it, and that's not so great either. The strategy that I'm playing going forward is I'm using my Roth IRA for this purpose, because if I get the gains I hope to get, it's tax-free. I paid an average of $20 per option. It's really per 100 shares of the option. So $2,000 for one option, really, $2,005, something like that. And they're currently trading at $105. So this is a good result, and I want to dive in and explain. I want to give you a simple understanding of how this works. So I asked Grok to explain it. Imagine a really simple case. You guys know I love napkin math. Imagine you're looking at a stock with a current share price of $100 a share, and you buy an option for 2 years from now with a $200 strike price, which means in 2 years, you'll be able to buy the stock for $200 from the person who sold you the option or whoever holds it now, the seller of the option. And the price of the option is, let's say, $10 per share. So it's $1,000 for one contract. Two scenarios. Now, for scenario number one, I have two scenarios here, but scenario zero is the stock doesn't go up to $200 a share and you lose your money. So you're out $1,000, right? And maybe it's like $202 or something, and you get something, but you don't get much. You don't get your money back. So there's a significant range where you lose money on these options. You either get zero, they zero out and you lose everything, or you don't get back what you put in, right? You have to recognize that risk is high, depending on the stock, depending on the future. And even with Tesla, like I think Tesla's going to go up, but who's to say some other crisis like COVID isn't going to happen that's going to throw a curveball into everything? Who's to say that, Donald Trump isn't going to turn on Elon Musk, that the deep state isn't going to like undermine everything and do all kinds of bad things? We don't know. Some kind of economic crisis, some kind of supply chain crisis, all kinds of things could happen that could get in the way. So my optimistic projections for Tesla's future are based on things not terrible things happening along the way. So Tesla's able to realize this really positive future. There's a whole variety of things that can happen that can get in that way. And if those things happen, we're screwed. Where if you hold stock, like the stock might go down $100, you still have the stock. If the options don't pay off, you get nothing, right? So it's a much bigger loss. Scenario number one, let's suppose the stock does outperform, and it does go to $300 a share when your strike price was $200 a share. So the option value at the expire of the option, when you exercise your option and you do it, is $100 a share, because you can buy the stock for $200, but it's worth $300, right? And you bought 100 shares, so that's worth $10,000, but you paid $10 for the option. So you lose money. So you end up making you lose a little bit there. So you end up making $9,000 profit on this contract. If you just bought the stock, you bought $1,000 worth of stock. So you bought 10 shares at $100 each. The value at expiry is $300. So you tripled, right? So your profit is $2,000. Okay, that's not bad. You don't mind getting $2,000 profit, but $9,000 profit looks a lot better. The options profit is $9,000 in this scenario. The stock profit is $2,000 in this scenario. So that is a Tesla option strategy. It's not the right Tesla option strategy. It's an option strategy I'm playing with. But again, limited percentage of your portfolio, and do not go on margin. Do not play crazy games with this. And I'm not advocating any kind of other option strategies. There's all kinds of option strategies out there. I am personally uncomfortable with anything that's short term. But high risk strategy from the outside, from anybody who's not deeply embedded in the Tesla community, somebody else looking at this will say, this is crazy, you shouldn't do that. That's why you limit it to a small percentage of your portfolio. This is a way of really maxing your gains, but I recommend, limiting it to a small share of your portfolio. I hope this is helpful. Please check out the t-shirts at elonbits.com. Please like this video, share, and subscribe. And thank you so much for watching.